Welcome back to our video series on retirement basics. In the last video, we introduced the idea of the tax problem in retirement and where we can go to help you generate tax-efficient retirement income. Along the way, though, we talked about one specific nuance that will have implications on your retirement income, and that is the pension decision. Folks, one of the strongest, most difficult decisions we find to make coming into retirement is how to receive your pension benefit. If you work for a company that has a pension benefit, there's a number of factors you need to consider. Today, we're going to jump in and look at what those pension decision factors are and how can we help you make the best decision. My name is Greg Parker with Engrave Wealth Partners. And as we talked about the tax problem in retirement, we talked about the potential sources of your retirement savings. Again, the pension, the 401k savings plan, and some of you having access to restricted stock units or supplemental pension plans. Talking specifically about the pension, however, we acknowledge that when it comes to thinking about retirement, you've got choices to make. And that pension decision tends to be one of the more confusing decisions. Now, first and foremost, you need to understand the idea of a pension is a tremendous benefit. Many companies today are not offering pensions to their employees in the future simply because the pension represents an obligation of the company. In other words, for your pension, you have not been contributing actual income into a pension. The value of your pension benefit is largely a factor of how long you've worked at the company, what your average salary has been, and your current age. Those valuation metrics are combined in different ways for most companies, but in the end, they provide some form of retirement benefit for you. The problem is that most companies give you a choice at retirement. You can choose to elect your pension benefit as an annuity, or you can choose to take your pension as a lump sum distribution. Now, what do each of those mean and what are the nuances of both? Obviously, it's difficult to give advice over a video like this as to which one's going to be best for you because a lot of it will depend upon your personal situation. But let me walk you through the decision steps that we take with clients when talking about how should I take my pension. Generally, we want to talk about the pension as an annuity or a lump sum, but before we do that, what's the difference? Simply stated, folks, an annuity is a promise of payments that are going to be made on a periodic, regular basis throughout the rest of your life or your plus a spouse's life, depends upon how you elect to receive it. The annuity means that you are basically going to retire and continue to receive a monthly deposit into your bank account every single month for the rest of your life. The lump sum distribution, as its name implies, means you're not going to get a stream of payments, you're going to get one payment. And that payment's going to come at the time of retirement when you elect the pension. Now, it's important to know not all pensions trigger immediately upon retirement. In fact, many companies allow you to retire and defer your pension. Now, why in the world would I want to do that? Well, the most common example is if someone's retiring significantly before age 60, let's say you're 55, 56 years old, you're going to retire. You don't necessarily need the income right away because you've got another source of income. It might make sense to leave that pension at the company because it could continue to grow and accrue benefits until you turn age 60. I know, even though you're not working for the company anymore, the pension could continue to grow. That's an important consideration to make, and it's something that we can walk you through when it comes to figuring out what retirement looks like, where your benefits are going to come from, and whether or not you need to trigger the pension immediately or sometime later on. Now, the two options, annuity versus lump sum, have different features and benefits. And I want to real quickly just run through what each of those represent. For example, in the annuity, if you choose to take the annuity, the number one reason most people take the annuity option is because it represents a form of guaranteed monthly ordinary income. Now, it's important you recognize what those words mean. Guaranteed is important because it depends on who's offering the guarantee. Is it the company offering the guarantee, or is it some third-party insurance company that offers that guarantee? And that's some research you'll need to do before you retire. Finally, I should also add that the annuity payments you receive are going to be treated as ordinary income. If you've joined us in the first two videos, you know that that word has some meaning to it. Ordinary income is the term the IRS uses to denote salary, wages, or other types of income that applies to the marginal bracket system. Simply put, the more you receive, the more taxes you'll pay. Those annuity payments are going to trigger and generate ordinary income for you every single month, every year. At the end of the year, you'll simply get a tax form from the company or from the third-party annuity company showing how much you've received, and it'll be reported to the IRS as taxable income. So why don't more people choose the annuity option? In all honesty, we don't see a lot of choices for the annuity these days. And the reason is there's some significant negative connotations to the annuity. Number one, the annuity payment has no inflation adjustment. Folks, when you retire and you decide to start taking the annuity payments, the amount of payment that you elect at the time of retirement is going to be the same for the rest of your life. There is no cost of living adjustment. There is no inflation adjustment for most companies. The inflation adjustment could be significant. Folks, if you retire at age 62, the average age of retirement in America today, and then you live to the average life expectancy of 87 or 88, depending upon male or female, what that's going to show you is 20 to 25 years of living in retirement on the same monthly income. Folks, I know many of you can think back over 20, 25 years ago and what you may have earned back then or what you may have had to purchase back then. And you know for sure that inflation is real. The things you buy today are significantly more expensive than the things you bought 25 years ago. Think about the problem that will represent in retirement if the income you're receiving today never changes. Folks, that's a significant negative factor for the annuity and the reason why most people don't choose the annuity. The other downside of the annuity is that it does represent a form of taxable income every month, even if you don't need the money. We've had calls from clients who say, hey, I'm retired for a couple of years now. I've got some other income sources plus my Social Security. I don't really need this annuity payment. Can I stop it and save it for later? And the answer is generally no. Most companies, once they start the annuity payment, it's going to come every month, whether you need it or not. And finally, because it's adding on ordinary income every year, it also limits the ability to do some additional tax planning. In other words, you're going to be receiving the annuity as if you had taxable income from a job, and therefore the taxable income you receive from that annuity is going to be income applying to the marginal brackets, limiting how much additional planning we might be able to do. Folks, it's a decision that's hard to make, but for many people, the annuity and that inflation adjustment or lack of inflation adjustment leads them to go to the lump sum. Now, what are the benefits of the lump sum? As we stated in the last video, the continued tax deferral of the lump sum is a major benefit. In other words, if you choose to take the lump sum distribution from your pension benefit, you do not need to pay taxes on that as long as the pension benefit goes to an IRA. Now, it's important. Most companies want you to designate that IRA before you retire so that they can send the proceeds directly to the brokerage company with the IRA. If they send you the check, there could be an issue if that check is made payable to you and you put it in your bank account. That might be treated as taxable income. You don't want to do that. Please make sure and note that a lump sum distribution needs to be made payable to an IRA or directly deposited into an IRA, depending upon your company. The other benefit of a lump sum distribution is now the money represents a lump sum in your IRA that can be accessed as you need it. If you look at a given year and say, hey, I need this much income, you can choose to take that income out of the IRA. But if you get to a certain month or a certain year where you don't need as much, or perhaps you have a certain month where you might need a little more, the lump sum distribution provides the flexibility that lets you adjust your income level depending upon your needs. What you don't need, you simply leave in the IRA. Months that you need a little bit more, you simply direct them to send you a little bit more. Income when you need it is a major benefit to having that lump sum option so that you can enjoy the flexibility of retirement income as your life changes in retirement. Additionally, because that lump sum is deposited into an IRA, most of you know that IRAs can be invested through brokerage companies in a wide variety of investment options. You can use stocks, bonds, mutual funds, index funds, ETFs, even money markets and CDs are available for investment with a lump sum distribution in an IRA. Finally, because of that tax deferral, it does give us the opportunity to consider some additional tax planning. Not having to recognize the taxes from a pension distribution in the year of retirement means we can be aggressive with other forms of tax savings that we're going to be talking about in later videos, NUA and Roth conversions, for example. Why would somebody not choose the lump sum distribution option? Well, simply put, a lump sum distribution option is very likely going to be the largest single amount of cash you've ever received in your life, and you need to make sure that lasts until you're gone. Folks, there's a lot of responsibility that goes with managing the risk of having that kind of money in an IRA, making sure that it's not invested too aggressively, but making sure it's invested enough to grow to meet your future income needs. That takes some advanced planning, and those are things that you can definitely talk to an advisor about, and we can help you build a plan that looks at your needs later in life and how the risk level today can help accommodate that later on. Now, the most natural question we tend to get when talking about the pension lump sum is most people want to know, how is it calculated? The pension lump sum is a lump sum calculation that's done by each company a bit differently. However, most companies rely on a given set of interest rates that come from the PBGC, the Pension Benefit Guaranty Corporation. PBGC is a government agency that provides a common link of interest rates that companies can use for their calculations to create the lump sum payment. Now, don't get me wrong, a lump sum pension option still depends on how long you worked at the company, your age at the time of taking the pension, what your average salary was, especially in those later years. But to calculate the lump sum, they're conducting a net present value calculation that simply says, based on the annuity payments you would otherwise receive, we're going to use a given interest rate to calculate what the lump sum would be. Now, that interest rate's important, folks, and the interest rate is important because it directly affects the value of your pension lump sum distribution. But the way that it works is a bit tricky. These are the rates calculated by the PBGC that were released in July of 2022. The interest rates fluctuate, and there's more than one of them that you need to know about. The interest rates fluctuate because they are benchmarks for various interest rates in the marketplace. The yellow line on the PBGC is known as the Segment 1 rate. The Segment 1 rate is a composite calculation of short maturity bonds, both corporate and treasury. Short maturity bonds simply mean those are bonds that have a shorter lifespan. They're going to mature before longer maturity bonds, typically somewhere between 1 and 5 years. The blue line represents what they call Segment 2 interest rates. These are meant to be more intermediate maturity rates, so perhaps bonds that are going to mature between 5 and 15 years. And then finally, the black line is known as Segment 3. Segment 3 interest rates are longer maturity bonds. These are composite bonds of corporate bonds and treasury bonds that generally have maturities of 20 years or longer. Well, why are the three lines at different levels? Well, simply put, bonds with differing maturities have different interest rates because of the risk you're taking. In other words, a long maturity bond that's 20 to 30 years out tends to have a higher interest rate than a bond that only has 2 or 3 years out. That's important when it comes to understanding the impact these rates can have on your pension lump sum. Folks, the PBGC publishes these rates every month. Generally, they move every month in different directions. But what you need to know is that recently these rates have moved significantly higher. And that's a function of what's going on in the market and in the economy. What we've seen over the last couple of months is that the Federal Reserve continues to increase short-term interest rates, which is what's driving the yellow line to move straight upward. In addition to that, the blue and black lines have been moving upward, but at a slower trajectory. Why would that be? Well, as the Federal Reserve raises short-term interest rates, it doesn't always play through to the longer maturity bonds. However, the longer maturity bonds are directly affected by other factors. Normally, you'll see longer-term interest rates like 30-year bonds start to rise when the economy is growing very healthy. But one other factor can affect long-term interest rates and make them move higher, and that is when we see increased expectations for inflation. Why are we seeing all three segments moving up together here, some faster than others? Simply put, we see things happening in the economy that are affecting these rates directly. Now, these rates are the base rate that the PBGC publishes. Every company uses them slightly different. Most companies take these three rates and they'll give you some form of deferral, meaning that these rates could apply to next quarter or next month's retirements. For details on that, either tune into one of our company-specific videos or talk to us about your company to see how your company's rates are calculated based on the PBGC. Where are these rates going in the future? Well, again, it's hard to predict that, and there's no crystal ball for this type of thing. But what we can look at are the factors that have affected these interest rates so far. And what you need to know is that so far, again, short-term interest rates have largely been affected by changes in the federal funds reserve rate. Folks, the Federal Reserve calculates short-term interest rates generally every 4 to 6 weeks. They meet, they talk about these rates, and they announce any changes they might be making. In 2022, we've seen a substantial increase in short-term interest rates, which is what's led that bar higher. But what's important about this chart is what we're showing is how the market expects the Federal Reserve to continue raising interest rates through the end of 2022, meaning that the upward trajectory of that yellow bar may not be finished. It might continue to rise and go higher. Further, the blue and the black line are being affected by inflation. And those inflation expectations continue to run very high. In 2022, we've now recorded the highest inflation rate seen in more than 50 years. Folks, that's bled into the marketplace. And as a result of that, both 10 and 30-year interest rates are continuing to move higher, and the composite PBGC rates reflect that. Those higher interest rates have driven segment 1, 2, and 3 interest rates all significantly higher in 22 than they have been in the past. Well, why does that matter and what's the importance? Well, here's the problem. The interest rate calculations have an inverse effect on the value of your lump sum distribution. The higher interest rates go, the more it brings down the value of your lump sum distribution. The lower interest rates go, it actually increases the value of your lump sum distribution, and that's part of the net present value calculations. The discount rate, in other words, these interest rates, have an inverse effect on the value of your lump sum distribution. As these rates have been rising this year, it's bringing down the value of a lump sum distribution. If you need help looking at that, calculating it, and figuring out how that affects your plan for retirement, please schedule some time to talk to us. Again, we're going to answer those basic questions, putting them into a big picture optimization plan for you. And there's no charge and no obligation with this plan. This is something we can provide to you with a little basic information from you. We'll build this plan out in 24 to 48 hours, provide it to you in a Zoom meeting or a meeting in person so that you know exactly how those interest rates are affecting your pension lump sum distribution. Folks, pay close attention to these interest rates, pay close attention to that inflation, because they both have detrimental effects on your pension lump sum distribution. For a detail on how that works, go to our website, click the Start Your Free Plan button. We'll get in touch with you about building out that plan so that you know what to expect. Folks, know for certain, nobody in retirement plans to fail. It's simply that they fail to plan. And if you'll take action today, we'll help you build out that plan. Thanks for joining us.